Hey guys, welcome back to another episode. Today we're going to take a closer look at three semiconductor and AI companies that have taken a massive beating this week. The first one we're going to take a closer look at is Coherent. Now, this is a company that provides photonic solutions for the data center market. Think about networking solutions. And we can see after the company reported earnings, the stock is down roughly 20%. Now, the second company reported earnings today, and that is Applied Materials. The stock is down roughly 14% after hours. And the final stock we're going to take a closer look at is one we discussed a bit throughout kind of the past few days. And this is going to be Coreweave, down roughly 22% in the past 5 days. And from its year-to-date high, the stock is down roughly 46%. So let's take a closer look in today's episode. All right, so the first company we're going to take a closer look at is Coherent. So for those that are not familiar with Coherent, this is a company that focuses in the optical space within the semiconductor industry. And optical solutions are very crucial for the networking side, most of the growth coming from the data center space. So right now, this company is sitting at a market cap of roughly $14 billion. Year to date, the stock is negative now, but if you kind of got at those April lows, the stock is still up nearly 81%. In the past year, the stock is up roughly 28%. So this is a stock that still has been dominating even with this massive drop. So this is the perfect way to kind of look at Coherent. They focus on various markets, networking and lasers and optics, but to me, the networking and the data center market is probably the most crucial, especially with the growth story. So they do things like transceivers, like active optical cables, components, and instruments, which are all very crucial for this data center market. For example, a lot of these optical transceivers, you have multiple of these per GPUs to communicate with other GPUs, with other networking solutions. And then you have obviously the active cables that are working here with those kind of optical transceivers. So this is a market that, again, has been very popular, especially in the data center space. Now, we're going to take a closer look at some great charts here. And obviously, all these charts can be found at fiscal.ai. I do have a promotional offer with 15% off. Make sure to check out fiscal.ai/Jose. This is the best platform if you are serious about investing. It's extremely cheap in my opinion, especially with that 15% off. So make sure to check it out. So here within Coherent, what I'm looking at is their data center, their networking revenue, and their networking revenue is mainly in that data center space. We can see this is something that has been growing pretty strongly. I mean, September of 2024, it grew about 61%. December of 2024, 55%. Now here in the previous quarter of March, it grew 45%. And now is growing 39% year over year in the most recent quarter. So this could be one of the fears, and I have a lot of other slides that we're going to look at to see some of the negative sentiments behind Coherent. But the first thing is the data center market is growing, but there is kind of that de-acceleration in growth. Still, it's becoming almost a $1 billion quarterly revenue segment. Most recent quarter was $945 million, so achieving almost that $1 billion run rate. Now, networking is one of their markets. They also have things like materials revenues and lasers revenues. Those other markets, unfortunately, for Coherent, have been non-growing. We can see they're actually been decreasing. The overall lasers revenue was down about 2% here, and the overall materials revenue was down roughly 15% on a year-over-year basis. So the only market that's really pulling ahead for them is that networking space. Now, is there anything really causing kind of this fear? So I want to say there are a few things here, and these are going to be sites that I've actually developed myself. If you want these sites, you can either become a membership outside of the no video, so the other two members outside of the initial one, the just pure support, and you're going to get links to all these websites that I'm developing right now. We already have a few. You're going to get them on a post. So here in Coherent, we can see that the main thing is there was a combination of disappointment for near-term guidance. There was also decelerating growth momentum that I was just talking about. Macro headwinds and competitive pressures have created this perfect storm of a 20% drop. I mean, if you just look at their fiscal year of 2025, and they just finished it with this quarter, their fiscal year 2025, revenue was up 23% year over year, even though this company is having kind of massive headwinds in certain industries, like we saw the laser and the materials. Their overall revenue, non-GAAP basis, was up 191% year over year. But now look at this. For quarter one, it was very disappointing. I mean, for a company that's expected to be growing in this AI era, any horrible guidance like this creates that massive slowdown. So for quarter one, which they're about to report in 3 months, midpoint guidance would be about $1.53 billion, which would pretty much be a flat sequential growth versus quarter four, which was about $1.53 billion. So you don't want to see that, right? You don't want sequential growth in the AI story. The other thing is at midpoint, there would be a small decline from quarter four's gross margins, which could be talking about some margin pressure. And obviously margin pressure would indicate maybe something wrong with the supply and demand balance. And if that's the case, it could be competitive pressure. It can also be just the lack of demand, which I don't think it's the second. Now, if we're looking at growth deceleration, if we look at the data center and comms market, in sequential growth in quarter one, it grew about 9% sequentially. In quarter four, where we're at right now, it grew 5%. And now we're looking at quarter one of next year, or the upcoming guidance. It's actually representing slower growth ahead. So right now, the CEO did mention that there is some lumpiness of demand and quarter-to-quarter fluctuation, but the trend line concerns investors. The other markets are still pretty much impactful. We also know gross margins would have the gross margins are impacting the company as well. Materials segment, they are kind of selling off a few parts here, but that is also still seeing a bit of a weakness. And overall competition has seemed to be a little bit stronger. So the competitive landscape, particularly from Chinese manufacturers, is heating up, posing a threat to future market share and margins. The CEO did claim, though, that Coherent did gain market share in fiscal year 2025, and the pressure, but regardless, investors are still curious about why the slowdown, especially with this upcoming guidance. So for me, I mean, Coherent is definitely one that's in an interesting market with the $14 billion. Optical cables are still going to be used for quite a while, and eventually NVIDIA and other companies want to move away from some of these transceivers and stuff like that because they do cost a lot of energy. But this is still a market that is very much needed right now. So Coherent, with this overall drop, maybe if we kind of even look at, let's just kind of reset some of the data, and let's look at ratios instead. So let's reset data. I want to look at forward valuations here for Coherent, and I want to look at what the forward PE ratio is. So forward PE ratio right now is sitting at around 20.1. Now, if I want to look at this more of on the median basis, right now is trading within its median that it's seen since January 16th, so almost a decade from now, almost a decade, not necessarily a decade just yet, but it's not screaming overvalued, especially right now. Now, if the data center market is going to pick up, and I do believe as well, Coherent wouldn't be a stock that I would be to worry about, at least at the moment, is what we're seeing, right? The optical market is still very, very crucial in the data center space. Now, the second company here we're going to take a closer look at is Applied Materials. Now, for those that are not familiar with Applied Materials, this is a company that focuses on equipment for the semiconductor industry. Now, the stock right now is down roughly 14% with the market cap of 151. When we wake up tomorrow, it'll probably be closer to $130 billion, maybe $125 billion of market cap after this earnings. Now, we're going to look at their overall investor presentation really quickly, but if you are enjoying the episode, please make sure to hit the thumbs up and the subscribe button. I'm trying to hit 75,000 by the end of this year. We're so close. I'm actually hoping that we might get it by the end of the month. That would be amazing. And if you could help me there, that would mean a lot to me. I also have a free newsletter for the semi and AI industry, whatthechipHappened.com. Make sure to check it out. So here with Applied Materials, we're going to look at some numbers too, but I want to kind of just showcase their overall third quarter numbers that they reported. And pretty much right off the bat, on the top of the press release, they mentioned that they are currently operating in a dynamic macroeconomic and policy environment, which is creating increased uncertainty and lower visibility in near term, including for their China business. They are expecting a decline in revenue in the fourth quarter, driven by both digestion of capacity in China and nonlinear demand from leading edge customers, giving market concentration and fab timing. So within the first few sentences here of the press release, many investors could care less of what they reported. What they guided for is a slowdown in sequential revenue here in the AI in the equipment space, mainly because of the Chinese market. So that creates the first biggest bearish sentiment, and we can see. The overall China market is a good portion of this company's total revenue. And that's where this company, one, the market most likely is not a huge fan that you have such a huge exposure to the China market. But number two, not only do you have such a huge exposure, but now you're also seeing some form of weakness in that space due to a few things. We're going to look at some geopolitical tensions, but obviously some timing as well. So in terms of the stock price, we can see the market right now believes the stock price drops on light forecast amid macroeconomic uncertainties. Now, if we look at this overall site, we can see that quarter four guidance would represent a nearly 5% year-over-year decline, non-GAAP earnings per share of a nearly 9%. Now, the company is saying that the sequential decline represents a 700 million equipment revenue reduction. 500 million of that is coming from China weakness, the other 500 million from leading edge timing issues. Companies like TSMC, like Intel, are not buying equipment right away, and that's creating some funkiness in the equipment space. Now, 700 million, right? I gave about $1 billion of revenue loss potential, but they do mention that there is a partially offset by some strength in the rest of the world ICAP spending. Now, the other thing is the China market, right? China is still a big portion of this company's total revenue. In quarter three, was roughly 35%. For quarter four, it's expected to drop roughly 29%. And management does expect that the China business to be 15 to 20% down to 2024 for the next few quarters. The main reason is they have taken a conservative position and assume that none of the licenses, they do need form of export licensing approvals to ship certain equipment, will be issued in the next quarter. We expect this to continue for several more quarters as well. So it does seem that this company believes they're not going to get approval to China. They might be hearing something, they might know something they can't really say, but they're guiding for it. And that's definitely creating a lot of pressure on the stock right now. Now, in forms of customer concentration, for advanced leading edge, one of the biggest things was their gate-all-around equipment. They did see kind of about that. We saw that $500 million loss. Now, obviously, reduced visibility. Management has talked that it's taking longer to commit to orders, eroding the multi-year visibility the company had previously bid. We've kind of fallen off that. Customers have been less certain, and the added visibility that we had put in place just isn't there right now. So when you hear kind of this bearish sentiment and kind of this uncertainty from either the CEO or the CFO in this part, it creates that kind of negative pressure on the stock. Finally, the macroeconomics, the CEO did acknowledge broad macroeconomics and policy changes are impacting the entire semiconductor industry. Certain semiconductor companies haven't been this bearish. I think out of some of the big semiconductor companies that we've heard about this earnings already, this is probably one of the more bearish takes and one of the more uncertain takes I've actually heard. I actually believe this is even more bearish and more uncertain than ASML, which also did kind of create some negative pressure for the stock. Now, the final company here that so with Applied Materials, would I be buying this dip? I would say no. I don't own Coreweave. I don't own Applied Materials. I'd rather own other semiconductor equipment players. If we're looking at the big dogs, and these big dogs are the ones that are over $100 billion plus, ASML would rather make that list opposed to Applied Materials. We can see ASML is down 2.8%, most likely on the sentiment of Applied Materials. And the second one would be Lam Research. Lam Research is another one that I would like, but we can see Lam Research is also kind of seeing that negative pressure from Applied Materials. So Lam Research and ASML, I think I would prefer over Applied Materials. Lam Research and ASML, I would prefer over Applied Materials. Clack Corporation is another one, but we can see Applied Materials is pretty much destroying the equipment space right now. We even have Clack Corporation down roughly 7% on the day. Now, or after hours. Now, the final stock I want to take a closer look at is Coreweave. So Coreweave down about 15% on the day from its overall 52-week high. The stock is down roughly to 45%, almost 46% there. Main reason, I don't think earnings were that bad. I really don't. I mean, this is a company that's investing a lot. They have a lot of debt. Losses were a lot wider than expected if you were looking at the bottom line number. And more importantly, it does seem like the lockup period that's happening right now is creating some fear for investors. Now, I don't think there's anything else here in Coreweave that is worth mentioning. Actually, with that high debt, we can see that the company is now paying almost, if it continues, right, in March 2025, they paid about $260 million in net interest expenses. And in this most recent quarter, they paid about 261. So here we can see on a yearly basis, they're paying over $1 billion in interest expenses alone. That is wild and insane. Hopefully, free cash flow picks up pretty quickly, but that's something I really wouldn't be too much of. I would see that as definitely a big bearish case for Coreweave. Now, with the market cap of $50 billion, if you do like the excitement of AI, I do believe Coreweave is now sitting at some attractive levels. I've talked about it in yesterday's episode. This is a stock where if I knew how to do options, I would be selling a put or two or three, depending on how big the portfolio is, right? And take some form of premium off that, and if it does hit that strike, I'll be able to buy Coreweave at a cheaper price because you do that kind of strike price minus the premium you paid. So Coreweave, $50 billion, I'm liking it. I do believe there's a lot of growth opportunities here, especially below that $50 billion market cap. Now, unfortunately, there's obviously that risk with that high debt, and that's something that investors should definitely not forget about. So out of these three, I think if I had to rank them in order, I'm a little bit more bullish in the AI infrastructure. So I would start with Coreweave, Coherent, and finally Applied Materials. Definitely not a fan of Applied Materials. In the equipment space, I think there's other better players out there. So I hope you guys enjoy today's episode. Take care, have a good day, and see you all next time.